Everybody wants to pay less in taxes, and there's only a few ways that you can do that legally. So in this video, I'm going to explain the idea of tax deductions and tax credits. Hi, I'm Evan Neufeld. I'm a certified financial planner, and every day I help people invest smarter and reduce their tax bill. One of the most common questions I get around this time of the year is, how can I reduce my tax bill? I don't want to owe money to the government. I don't want to do this and that, whatever. And so there's only a few ways that you can really do that legally, and the two concepts that you need to know are deductions and credits. Deductions work at the high level and credits show up at the end. So let's talk about deductions first. So when you have employment income, when you file your taxes, they take your total income that you earned and then subtract any deductions before you get your tax bill at the end. So a deduction takes your gross amount of income and reduces it, meaning you'll pay tax on less income. So some of the most common deductions are RSP contributions. So when you add money into your RRSP, or your Registered Retirement Savings Plan, you will reduce your income so that you will pay tax on less of it. So if you had employment income, you've already paid some taxes on that money. So your gross amount, you didn't actually receive that in your bank account because some of that already went to taxes. So that means for you that you're actually going to get a refund based on that deduction. So RRSP contributions are a very, very common deduction, and the one that most people are going to be able to use voluntarily. Some of the other ones are a little bit more specific to your circumstance. So childcare expenses can be used as a deduction, as well as home office expenses. So if you're working from home, there could be an opportunity to reduce your taxable income through that deduction as well. Union or professional dues can be really common. Moving expenses, if you're moving under certain circumstances. So I moved last year, but I just moved a couple of blocks away and there was no reason that I needed to move necessarily, so that wouldn't count as a moving expense. But if you're moving over a certain distance for the purpose of working, you might be able to claim that as a deduction as well. Medical expenses can be really common deductions for people where that would apply. So if you're paying out of pocket for procedures or prescriptions over a certain amount, you can use that to reduce your taxable income too. There's many deductions that are available, so have a look at your personal situation and have a look through Canada Revenue Agency's website to see if anything else might apply. Now, once you have your net income amount, so you have your gross and then you have all your deductions, then you have your net amount. Then your tax bill is calculated based on your marginal tax rate and your province and all those other things. If you aren't familiar with how that works, you can go back and watch my video about marginal tax brackets and understanding the high levels of how income tax is calculated in Canada. But once you have your tax bill, that's where tax credits show up. So tax credits can be a little bit more complicated because you might see something like a $1,000 tax credit or a $5,000 tax credit. That doesn't mean your tax bill is reduced by $1,000 or $5,000. There's always a rate that is multiplied by the credit amount to get you your actual reduction in the tax bill. For many tax credits, they use the lowest federal rate of 15%. multiplied by the tax credit amount to get your reduction. So as an example, if you had a $1,000 tax credit and the lowest rate is 15%, you would multiply $1,000 by 15% and you get a $150 reduction in your taxes. Tax credits can be really complicated because there's so many other factors that come into play with them. So things like the age amount tax credit, that is scaled back based on how much income you have, which is a high level amount, but it reduces your tax as a credit. So it can be a little bit complicated to calculate. But if you're using software that calculates credits for you, that can be really helpful. Also, working with a tax professional is something that I always recommend, especially if you have a relatively complicated tax situation. They'll be able to understand your tax credits and apply that properly to your tax return. Now, one other thing to note when it comes to tax credits is that there are two types. One of them is much more common. The most common type of tax credit is something called a non-refundable tax credit. Non-refundable just means that you can't reduce your taxes to below zero. So you can pay zero taxes in theory, but you can't pay less than zero taxes with a non-refundable tax credit. So for example, say you owed a total amount of $1,000, but you had non-refundable tax credits of $1,500, you would not get an additional refund of $500 in that case because that credit is non-refundable. Now the other type of tax credit is called a, you guessed it, refundable tax credit, and that is where you can actually reduce your taxes owing to below zero, and you will actually get some money back back even if you don't owe any taxes at all. These are few and far between these days, and so there aren't very many refundable tax credits worth talking about here on the video, and these things change all the time. So make sure that you understand how your tax credits work for your situation so you can better anticipate how much you'll have coming back to you as a refund when you file your taxes. If this was helpful for you, let me know down in the comments, and consider subscribing to see more topics just like this about taxes and investing specifically for Canadians. If you want more content today, you can check out the Canadian Money Roadmap podcast right here on YouTube or on Apple Podcasts or Spotify or wherever you listen to podcasts. Thanks so much for watching, and we'll see you in another video.